Okay. Hello guys, how are you guys doing? I hope you are doing fine and well. So, yeah, it's been long as usual. Be busy. That is all I could say. But I hope you're doing well, and I hope you've been learning and progressing in your trading. So today I'm going to be talking about something important, and it's all about the algorithm and everything on how I analyze the market and try to predict the price. Now I was recording yesterday, but it happens to be my recorder wasn't on, so I wasted 1 hour of my time trying to create a content yesterday. So today I'm making sure that it's recording down here. Is it actually recording? Yeah. Okay. So I'm going to be talking about how I analyze the market and how I get to find my golden day range. Now, the first thing I would like to tell you guys about is to be very mindful about your structure. Okay, so I'll first of all introduce the structure. I know you already know this, but let's just say we are having a bullish structure. Okay, now when you see the market trade lower and it didn't mitigate another block that you have below right here. Now, it happens to be that the market traded into a fair value gap. Now, I'm trying to answer some questions, something that gets confusing when it gets to market structure first before I get into the algorithm. Now, when you see that the market trade into a fair value gap and did not mitigate your order block, and then you now see it rally upwards, okay, and you now see it rally upwards. This right here has finally broken a structure, right? And remember when I introduced market structure, I don't know if it is on YouTube, but I introduced it on the mentorship. I talk about the structure and everything about the market being liquidity, because every highs we have a buy stop liquidity resting on that high, and every low we have the sell side liquidity resting on the high, on the low. All right, we have buy stop and we have sell stop. The high has buy stops, and the low has sell stops. Now, if the market wants to go bullish, it leaves the sell stop protected and it goes to take out buy stops right on every high to maintain a bullish structure. And for vice versa, when it comes to a bearish market, when the market has to go bearish, it leaves the buy stops protected and it has to take out the sell stop. Alright, now when something like this happens, the price didn't mitigate another block, but then it traded into a fair value gap and goes bullish. Now, what you should know is that the market didn't mitigate another block and it has already broken structure. So that means we are now having another break structure and might be looking at another area to buy the market around here. Okay. Now, if it happens to be that the market traded lower, right, and it happens to be that it wants to shift structure. Now, if the same thing occur right here again, it trades into a fair value gap, and we now see a failed high occurring right here. Now, you should take note of all of this going on your chart. It is very, very important you take note of all of this going on your chart. Now, you now notice that probably a failed high occurred right here after it traded into a fair value gap and goes higher. Now you get to see a structural shift, and it happens to be that it's traded lower to violate this other block. Now the reason of this is because it is trying to go to take out sell side sell stops on those lows, and it has shifted its structure because it has given us a structural break right here. All right, because normally, due to the fact that you might not be able to spot your real structure, you might be looking at another block right here to buy, but then price violated you. Now the reason price violated you on this other block you're willing to buy, due to the idea that price is buying from a fair value gap or price is buying from another block. Now this other block won't be valid for the reasons that it did not go higher to break this high. All right, so it is not valid because we did not have a structural break. Now if price is retracing backwards, it is going to violate the other block, and also these ones that is unmitigated, they are no more valid. Now the reasons why it is no more valid is because the other block that was expected to push this price higher and continue the bullish structure has been violated. Now remember liquidity. liquidity on every high, buy stops, liquidity on every low, sell stops. Now, since this high failed to take out this high, it is now protected, and that means the market wants to go lower to take out every opposing side of the liquidity. And the opposing side of the liquidity are liquidity that it left behind to come back for it in future. So that means your unmitigated order block will react just little and you get violated. The same thing occurs right here and you get violated. Alright, so if price didn't tap your order block and it gives you a structural breaks, then the order block is no more valid. Okay, it is no more valid for you to enter the market unless the market trade into a fair value gap, it trade higher but did not break structure. Alright, so that means you're expected the market to come back lower and mitigate your order block, and then you rally higher. Then that means that this low it gives you right here is a inducement. Alright, because it gave you a swing low into a fair value gap and starts to go bullish but failed to break structure, and then it retraces backwards, so it trades into order block, and this right here is an inducement. Now take note, another thing also is also to take note of your external highs and lows. All right, and your external highs and lows are the major highs and lows where you are having a buy stop and a sell stop that is protected and the other one to be taken out. Now if your external high or external low is not broken, then that means it's not a valid something. Now an example is you have this external high right here, you have the external low. Now you saw an internal structure right here called the substructure. Some talk structure about permanent secondary structure. So you're having an internal structure right here. All right, and the reason of this, the reason I'm saying this is because those that are on the lower time frame that don't take note of the restructure. All right, you are to look from a higher time frame to know your overall trend and your overall structure, to know if you're bullish or bearish, to know if another block you're looking at might be a good place to buy from or not. Now take note of your external highs and lows. If an external high, like you're bullish in the market, now if an external high is not broken, then that means an area of demand you're willing to buy from right here won't be valid. All right, now I know that you might mark this right here as a structural break. This is a internal structural break, an internal liquidity break. All right, not the major swing high. Take note of your major swing high and low. Major high, major low. All right, take note major high and also take note major low. Every other thing you see inside of this, they are not valid if it gets broken. All right, so you should take note of this. If it was only this that break, you can say you have a change of character, but you do not have a second structural break that confirms you're having a bullish structural shift, because right here, you know, it is a bearish market at this point on the lower time frame. All right, now you have a change of character, but you don't have a break of structure. It is not valid to say you're having a structural shift to go bullish and for the market to realign with the higher time frame buyers. All right, so you should take note of your external high and take note of your external low, and make sure that before you execute a trade, make sure that your external high is broken before you look for an area of POI to trade from and swing your trade possibly. Yeah, so now I hope that you get to understand this and take note of your structure. Know when price taps to a favorable gap and rally higher, then if you break structure, then your other block you're looking at, it is no more a valid POI to look at. It is now liquidity if price retraces backwards and shifts structure. All right, so you should take note of that. All right, don't get confused about POIs, other blocks and stuff like that. So that is just a brief explanation on to clear your mind when it comes to structure and identifying a point of interest. Now we talk about talk about how I analyze the market and use my algorithm daily range, which is known as the institutional price derivative algorithm, which is it interbank probably. So IPDA algorithm prediction. All right, so now the first thing you should do is start your analysis from where? Higher time frame. That is all you need. You have to start your analysis from your higher time frame. Without you looking from your higher time frame, you will not be able to predict the algorithm. All right, you will not be able to try to find your algorithm daily range. So the first thing you should do is start your analysis from your higher time frame. That's all you need. And what time frame am I trying to tell you? The time frame I'm trying to explain to you is your monthly time frame. Okay, so that is the time frame you look at to find your algorithm daily range. All right, I know that we are all humans and our conscience tends to hit us, and our psychology they hit us, that most of the times we don't follow these rules, including I myself. Most times I don't follow my rules. I don't look for my algorithm range. I don't start my analysis for my monthly time frame, and it's normal and applicable to everyone. Excuse me for a moment. Okay, so all right, I'm back. So we start analyzing from our monthly time frame. There is the point where you have to read your algorithm prediction. And if you haven't watched the video, you can go back to my videos and look for the algorithm prediction, algorithm range. I think I made 2 of it, so you should understand. You should go watch the videos. So now from your monthly time frame, that is after finding your bias, you check your structure, you check your bias before you roll down to your lower time frame. Now, what are you looking at, or what are you looking for on your monthly time frame? Number one, what you have to look for is, first of all, check the trend. And when I talk about check the trend, if it is bullish, that is what you should check. Check if it is bullish, if it is bearish, or if it is ranging. So I'm going to explain this right now. Alright, so check the trend if it is bullish, bearish, or ranging. Now, when you go to your monthly time frame, you check your structure, mark out your structure, your higher highs and your higher lows, and you know if it is bullish. So, for example, let's just say we are in a bullish market. So, you know, when we are in a bullish market, we are expecting price to trade into another block on the higher time frame. We look for a confirmation entry on our lower time frame to swing the trade up to a high right here to take profit on the swing high, because the market has been bullish. So we are looking for higher highs and higher lows, and we're looking for other blocks to execute trades and target a swing high that is bullish. Now, when you see the market like this is not where I use the algorithm daily range, because the market is clean. All right, this is a clean structure, is a clean market, so you can easily know where to buy, and you can easily tell the market is bullish. So we don't use algorithm daily range on a clean trend. We don't use it in a bullish trend. We don't use it in a bearish trend where we're having higher highs and higher lows. Now, where are you expecting to use your algorithm daily range? We use our algorithm daily range where market starts to range. All right, on our monthly time frame. And when I talk about monthly time frame, it means the monthly candlestick. That is what you should focus on. Now, let's say we're having a bullish structure. We have higher high, we have higher low, we have higher high, we have higher low, we have high high, and then market starts to range like this. Now, this is the point where I mark my daily range. All right, this is where you use your algorithm daily range, and it is mostly used on, like I said, the monthly time frame. So you use them on your monthly candlestick. All right, so you can see right here, we know that the market has been ranging in this swing high right here is be ranging on a swing high. Sorry about that. So it's be ranging on this swing high, and this swing low is ranging right there. So it tells me that the market is no more bullish, because we are now having some kind of consolidation. So we don't know the bias anymore. I don't know if it's bullish, I don't know if it's bearish. So it is a range market. This is the point where we use the algorithm daily range. That is why it is called algorithm daily range, and it is mostly done on the monthly candle. Now, the reason why it is done on monthly time frame and on the monthly candle is because the algorithm deals on the monthly chart, which is the monthly candle. the institution, the central banks, and the hedge funds, the people that would like a long-term return on investment, all right, not a short term. So they trade on higher time frame, they trade on the monthly time frame, all right, for higher return. And now it has to do with a contract that has to come in every month, all right. So it has to be every month that a contract comes in the market. So it's a monthly stuff. So the algorithm tends to deliver the price each and every month to areas where we're having the buy stop and the sell stop, and the highs and lows are printed on the monthly time frame. All right. So when the market opens on a new month, the first week of the month, the algorithm prints a high, and before the month end, it prints a low. So during that month, we're having a contract within that month where orders are being accepted and executed on that particular month. So it gives you a high and it gives you a low, and then deliver the price to both sides of the market. All right. So use that to tell or predict the price, to know where the market, the algorithm has to deliver the price. Now you pay attention to your monthly candle and notice if you see something like this. All right. So also note previous that, and also if you check the algorithm prediction I talked about us marking out highs and lows of previous months. So we are marking algorithm to go for the buy stops or sell stop resting on previous 1 month high and low, previous month high and low. We also take note of the highs and lows, the buy stop and sell stop resting on previous 2 months highs and lows. We also take note of the buy stop and sell stop resting on previous 3 months highs and lows. We take note of the buy stop and sell stop resting on previous 6 months highs and lows. And also we take note of the buy stop and sell stop resting on previous 12 months highs and lows. Now I prefer looking at buy stop and sell stop resting on previous month highs and lows, because that is the area where I like to trade in, and probably try to see a swing trade. Now, one thing you should know is that all of this, it is a ranging market, it is daily range. Every structure you're seeing on the lower time frame is just liquidity, and the algorithm needs to quickly deliver price up to a high or down to an area where we're having set stops. All right, so you might not be seeing a clean structure, and most of the times you won't find entry because price has to quickly deliver, and most time it does that with printing a choppy market, liquidity market, to go for a high or a low. All right, and sometimes it goes one-sided. All right, now what I mean by it goes one-sided is you get to see it trade like this. All right, it doesn't give a structure, it trades like this, and what it's doing is that it's trading into a fair value gap, and you can still find an entry right here when you're trading sessions. So that is not what I'm going to cover here. That will be next time when I'm prepared to make a content for you guys. So take note of the structure first. Most sure your monthly time frame. Check if the market is on a ranging candle, and that means observe your monthly candle if it is likely to look like this, so you know that you are on a daily range. Okay, so it is very important you take note of this. All right, so this is where you find your algorithm daily range. All right, so the next step, take note of the highs and lows. All right, mark them out and notice the side that the market decides to take first. So that's what we're going to talk about now. So we have this candle right here. So this candle will be referred to previous month's high and previous month low. Okay, so this is the monthly candle that we'll talk about. Now the next thing you should observe is to observe how the next month opens. Then check if it trades lower, or if it failed to go lower to take this low. Now let's assume that the price traded lower, so let's make this one longer. So let's say the price opened the next month, and let's say for example the market has been bullish. right? So take this out. I'll probably use it. So let us say the market will be overall bullish, and you now get to see this range market right here. Okay, so you notice that the market opened the next month and it traded lower, and when it traded lower it haunted previous month low, and when it took that previous month low liquidity, you get to see trade backwards impulsively. You know that this is a hunt and not a breaker structure. But when you're on the lower time frame, you are seeing all sorts of structure inside right here, and you might be thinking that this is the breaker structure. No, you should observe the 3 range. Okay, so you take note of what happens when the market opens, if it takes out previous month low, or if it takes out sell side first, or it takes out the buy side first. So now if it takes out sell side first, then that means you'll be targeting the buy side, and most of the time price will go to take out that high. It might just a little bit try to take out that high and then push back when it comes to the next month. So you should take note, is it the sell side that was taken out first? So if that was the one that was first taken out, then you look for entry and you target the next area of stops, which is what? Buy stops. Now how do you know you might be looking for a shift right here? Alright, so the first thing you should notice is to find, like you see this hunt that occur right here. On the lower time frame, you get to find a stop hunt plus a break of market structure, and then a return to other block. So what do I mean? You get to see something like this printed on your lower time frame. You have the structure giving right here, right? So you have a stop hunt and another block was printed, and you see an expansion, an impulsive rally, 3 candles, not just a single candle, because single candle is a sell side imbalance, is a buy side imbalance, buy side inefficiency. So the price will just come back and balance that area with sell side, and it might not be valid. So it's better you have the fair value gap after the other block is printed, and that is 3 candles, possibly expansion, and you have a what you have now having, you have a stop hunt. Now this stop hunt, you should observe it clearly and very well. It should be like a week. So you have a stop hunt plus a break in market structure, and also take note of this slope right here. Okay, so it should not be like creating resistance right there. So you should take note of your structure, take note of the stop hunt plus break in market structure, and the violation of another block right here. So we will have a change of character right there, and a also if it has 2 structural break, you have a change of character and you're having a break market structure. So price is to return downwards towards the area of demand where you were expected to buy. Now before you are expecting to buy at this area of demand, make sure you're having a liquidity assessment. All right, so liquidity assessment is like a liquidity created around your POI before price break structure, and also if price trades backwards, still trade with liquidity, and tap the other block and continue to the other side of the market. All right, so you conduct like liquidity assessment to confirm your entry, that price we have to take that liquidity, use that liquidity to activate the order, and then rally again. Now the next thing is which time frame are you to look for this. Now when you notice your monthly time frame, this something like this, you are to look on, run down to your 4 hour. All right, and it is your 4 hour you confirm that structural shift, not 1 minute, not 5 minutes, not 10 minutes, not 30 minutes. Go to 4 hour, 3 hour, 2 hour, and the least could be 1 hour, but it's advisable there is 4 hour, because the 4 hour is the next strong time frame that traders look at. All right, so you look at it 4 hour, and also the least is 1 hour time frame. You look for a stop hunt and the structural break, or rather still you can get a shift in market structure. And what do I mean by a shift in market structure? So the market has been bearish, right? The market has been bearish. You have a lower lows and lower highs, and you see this low take out previous month low, right? And you see trade a high, and possibly when it traded into that high, it traded into an area of supply or bearish order block. Now it rejected from there, and you're expecting it to take out this low, but it did not take out that low. Instead, it reversed backwards and violate the area of supply of break order block you're looking at right here. Because it didn't break this low, it has to be violated, and it gives a change of character and a break in market structure. So you're now having a shift in market structure plus a change of character, or plus a break in market structure, and you'll be expecting a return to order block, which is the one responsible for violating and opposing order block. And also make sure you have your liquidity assessment. All right, price should tap your POI, and then you now be able to swing it and target the opposite side of liquidity. Now the next thing also is to take note of the other side of the swing low. It should be a slope. All right, so it should not be equal, because if it has to be equal, then you're having liquidity, and that is now has an area of support. So price will still come back and take you out and might continue to go lower. So you should be observing all of this on your chart. 4 hour, the least is 1 hour. Okay, so now as I've explained all of this stuff, it is very important you know your structure and all this stuff, and very important you're looking from your higher time frame. So now we will be going to our chart to observe this. All right, so we are now going to Euro USD, and we activate our chart. All right, so we then look for charts. Okay, so where is the chart? All right, so this is our chart right here. So what I'm going to do is I am going to delete all of this mess right here. So take them off. Now you can look right here on Euro USD that the market, it is not clean right here. You know this is a consolidated market, it's a choppy market. And also this right here, the same thing. You can also see it everywhere on your market that you're now having a clean chart, and also you are not seeing a structure. All of this that's giving right here, they are not structure, including what happened right here. All right, but on your lower time frame, which is the 5 minutes, you might be thinking you're seeing a structure right there, so you might get confused of having a directional bias of where the market is to run to. And also this right here, it is not a structure. This expansion is not advisable to look at most of the times. But then all of this has to do with our gravity range. Now looking at this, you know it is not clean to your eye. Looking at this from the 1 hour time frame. Also, if you run up to the 4 hour time frame, you will see that all of this is messy. All right, the chart is messy, it's not clean. Now this is your area where you get to use algorithm range. So advisable that you always run down to your higher time frame to know your bias. Okay, so right now we are on the monthly time frame, and we can still look from this side, but this is the past, so we are now looking at our current structure to know our bias. All right, so right here, the first thing I can notice right here is that the market right here did not give me a structure, so I don't have a bias if the market will want to go bearish or want to go bullish. But we can see the overall market that right here currently is that it is bearish, and also no structure was found here. Now the reason the market traded this way is for it to go and take out sell side. All right, take out liquidity resting on sell stuff. So right here currently, after the algorithm took out liquidity from sell stops, it quickly rallied backwards. So this is a fake breakout on retail support. So we now see impulsive trade upwards, and we did not get to see a structure form here. But on the daily time frame, you could possibly see a structure form right here on the daily time frame. So the daily time frame is advisable to look at when you want to see a structure. All right, so it's the daily time frame. But then the first thing you should check is your monthly time frame to know if you're in a daily range or not. Now you now see the market rally upwards, and as it rally upwards, we see that it starts to range right here. Right, so this is now where you get to use your algorithm range. So we start with this. We have January, right? So the market was bullish. All right, take notes. The market was bullish. January gave us a high. January gave us a low, right? Now February opened, did a hunt on January high. So right here we have February high. Now you can see that the first one that was taken out was area where we have the buy side, the buy stop, right? So this is the hunt because the next one opened, took it out and traded lower. So we might be looking for sales to target this low, but then it happens to be that it did not go to take out that low because from here it's been bullish. So we could possibly run down to the lower time frame and we see what was printed right there on February high. Okay, so this is February high, and we can see what happened right here. After it took out January high, right, it gave us a shift right here. So it's a stop hunt plus a structural break right here, and you can see that it didn't trade backwards to this POI or the fair value gap right here, because it has to quickly deliver price throughout the month, and it happens to be it didn't go lower to take out January low because the market has been bullish, and this right here is an order block. So it's a place where we like to exit the market on the month of February before we enter March. Alright, so possibly on the 4-hour you might get to see if the market did give an entry right there on the February to execute trades. So right here it didn't give us an entry, but then it happens to be that it traded into an imbalance right here before it traded lower. So even if we go down to the 2-hour time frame, we'd like to see what we have there, and this is it right here. Alright, so it put back and now rally downwards. So you can see why it's been doing that. It's been choppy, and it's not even a clean chart. It didn't give you an entry because of what? That is the algorithm. That is what it has to do when it comes to the range. That is what it has to do. Okay, so we don't know what happened right here, but it traded backwards. It could be an optimal trade entry and traded lower to January low. So we go back to monthly time frame. So you can also see me use this on gold when I was introducing the algorithm prediction. I showed you guys with gold, I showed you guys with BNB and S&P 500. So you can go and study that also. So we have seen February, and now we notice that March also did open, right? Now when March opened, we see trade lower, and what did they give us? It gave us a structural break right here. Right, it hunted February low, and I think there was this point. It was at this point on Facebook I told you guys that we were buying Euro. Now, what is the reason why I have to buy Euro? The reason was that we noticed that we have a structural hunt right here, right? So that hunt occurred, and you can see the market doing this small structural liquidity right here and balancing every area where we have imbalance. Then it's now violated and broke this area right here, and when it broke that area, you can see it traded back into that area of supply that it violated. So this could be a breaker block or some stuff like that, and it quickly delivered the price. Right now, this is the only place where it gave a clean structure. And what do I mean by the only place where it gave a clean structure? You can see right here it gave us a high right here and give us a low right here. Then we now also see a trade higher, give us a high and give us a low right here. Now I know that most of you guys will be asking why I did not mark this high and this low as a structure. Now the reason why I did not mark this high and this low as a structure was the case that it is internally, alright, it is in a range high right here, and also it is in a range low. Now this high and low is my external high and low that I'll be waiting to see a structural break before I'll be looking at an area of order block to buy or sell from. So this is internal structure and not something that broke structure. It didn't break structure, it is internally. So it is not considered a structure. I'm only considering my external highs and lows as a structure. So we finally have that structural break right here, and all responsible was this order block right here. So if you go to the 6-hour time frame, you'll see that these two candles is an order block. So price trade higher again, gave us a high, and which is a structural break right here, and then it traded backwards again into another block, trade higher, and we can get to notice what occurred right here if we go to our monthly time frame again, because we are on a daily range, right? So we observe again, we see our daily range right here. So you can see that this is April traded higher, right? And when it traded higher, it took out previous 2 months high, right? 1 2, and it starts to range again because we were expecting to see a clean structure like a bullish structure trade higher and go for this high, but then it starts to range again. And what did it do? What it did is that it didn't go when market opened, it traded higher, but when it traded higher, it didn't take out the previous month high. So if again you roll down to your lower time frame, you would see that what it did there on the lower time frame, which is the 4-hour, is a structural shift. And I explained this on Facebook, and those that had my contact on WhatsApp, this see me explain it right here, that I'm looking for sales on Euro USD. Now, what is the confirmation? We remember we marked a structure. We have marked a structure high right here. We mark a structure low right here that traded into this other block, and we now see rally higher. Now I am not considering this right here as a structural break due to the fact that it is not a body that broke this high. Alright, this is a wick that traded higher, and this wick grabbed liquidity, and then it traded lower. Now you could possibly mark this as a structure. I know you will mark this as a structure, and you will mark this as a high, and also mark this as a low. Now you should observe, you can see that the external high was not broken, but you are having a substructural break right here, and also you mark this as a break, and also you mark this as a break, and then you are considering this to be your other block where you want to buy right here. Now you can see that the other block didn't play out for long. Now why did it not play out for long? The reason why it didn't play out for long is because it did not break your external high. Alright, your external high was not broken, so you are having a shift, but then we only confirm the shift if the demand is broken, and that's what happened right here. Okay, so it didn't play out for long, and we finally have that structural shift right there. Okay, and you can see that since then, since it shifted, it's been trading one-sided, and why trading one-sided is been trading into fair value gaps. Right here we trade into fair value gap, also right here. So you can see that they are all 50% mitigation. We trade into fair value gap right here, also areas where we have imbalance, and you can see it doing that one-sidedly due to the fact that it has to quickly deliver price downwards, so it's been trading one-sidedly. Okay, so right here what we have here was a break mitigation block right here. So you can see the clean delivery right there. Right here we didn't have imbalances, but then we can see that when the shift occurred, it traded into this other block, rejected from that other block before it traded lower, and also we have a mitigation right here. It traded lower, and finally we now see it dropped and collapsed downwards. And where is it drawn to? We will be looking, though it has already gone for that, we're looking at this low right here, and I think that was the previous month low. Okay, so you should always study your market. This will help you be a better analyst and be able to predict the market in the possible future, depending on how you practice and how you spend your time in the chart. So let's look at another major pair that everyone is trading, which is GBP USD. So I am taking off all of this right here. So the same thing on Euro and GBP USD is similar to Euro USD, right? We have a ranging market, price trade lower to take out sell side, and when you take out sell stop doing a fake out break, it retraces backwards positively, and you can see that it traded higher. You see that expansion right there, and at this point, this is where it starts to range. So this is the area where we will be looking for our go in the day range. Now observe, for example, right here, price has been inside a fair value gap, right here. All right, so you can see it trade into 50%. So that is area where we're having imbalances. You see the ranging market, January high low is the bullish candle, price traded higher, failed to take out this high, so we'll be targeting this low, but then it traded lower and failed to take out this low. Then the next month, which is March, price traded lower. What did it take out? First, it took out previous 2 months low, or previous 3 months low. We have 1, 2, 3, and when I talk about 3 months low, you mark the lowest low in previous 3 months and the highest high in previous 3 months. So we have the highest high in previous 3 months, and that highest high is giving us liquidity pool right there. So we mark previous 3 months, the lowest low in previous 3 months, the highest high in previous 3 months, the lowest low in previous 6 months, the highest high in previous 6 months, the lowest low in previous 12 months, and then the highest high in previous 12 months. We have the hunt right here, and it was this during March I told you guys that we'll be buying GBP USD and we'll be targeting what? February high. I say that on Facebook, and the reason is what? I noticed what the market did here. We have a hunt, we finally see trade higher, violating an area of order block right here, and use that as a breaker block. Now how is it a breaker block? You are seeing this as a breaker structure, right? Because you don't understand the according day range, so you only know about structure. It's very, very important you know the according day range. So you're seeing this as a breaker structure, and you're looking at this area of supply to sell from, but it becomes violated, so it becomes a breaker block. A failed order block is a breaker block. So you quickly use this as a area of support, and you now see rally upwards without creating a clean structure for us. But then it kind of gets interesting right here, because we have this high, low, high, traded into a fair value gap right here, 50%, and then we now see it impulsive trade higher. Now let's go back to our monthly time frame, and we will still look at our daily range. So we hit previous 3 months high, higher, and we were expecting to go higher. All right, we were expecting a bullish pricing, but it happens to be that this current month opened and we have a hunt on previous month high. Right now we will only go bullish if we didn't see a structural shift, but then it happens to be that when that hunt on previous month high occurred, we had a structural shift. So these are previous month high, right? And what do we notice on our 4 hour? What we noticed on our 4 hour is that we had a stop hunt plus a break in market structure. We have that high, we have this low, this is a clean structure. We have this high, and this high, you can see that it did not impulsively break the high, so this is a fake break. All right, so that is a stop hunt. And then what do we notice next? We notice a break in structure. So this is a shift, this is a break market structure, giving us a structural shift, telling us that okay, we have a stop on the previous month, and it's now shifting to go and take out previous month low. So if you run down to the 2 hour time frame, or possibly the least time frame, or like advice to look at, you can see right here on the 1 hour time frame that we had a stop hunt right here plus a structural break. Right now, if you all notice and observe that when we have a structural break, you can see that the market quickly traded backwards into what? An area where we are having imbalance, right? So we have this imbalance right here, and then it traded also into a liquidity void. All right, so we have liquidity void right here, so we label that liquidity void. Okay, so it's very important you pay attention to every details that I'm giving you right here, because you need that to be a good analyst and be able to predict the market. We traded into the imbalance, we filled in the imbalance, right, and also the liquidity void, and you now see the positive trade downwards. Now when you trade downwards, you should observe what it's been doing all this while, like imbalance, imbalance state, because there is nothing here again to balance. Price has already balanced right here before it possibly trade lower to give us a structural shift, so it reverses backwards to balance the price, right? So we now see it violate again, trade lower, and right here it trade backwards to 50% of our fair value gap, right? And it trade lower again because it has to quickly deliver the price, so it won't give you a structure because it is a ranging market. All right, it's a daily range, so it's most likely to trade into a fair value gap, and you also need to take note of your structures. Okay, so we have a structural break, and also we have the structural break right here. So price trade back again, possibly we might be seeing a 1 hour fair value gap right here. So we go down to the 1 hour, and it's already our supply, so it traded into it, and we now see it drops again, and when it drops again, it traded into another block, drops again right here, it traded into another block again, and it drops. All right, so you can see that delivery right there, one-sided market after it did a hunt on previous month high, and now it's been creating liquidity and leaving them behind because it has to come back to that in possible future. So I hope that this content helps you a lot, and that is how I was able to being able to predict the market and tell you guys about the price delivery in the chart. Now I know that most of you guys are still looking right here to sell GBP/USD, but the market didn't come back, and it's been creating all the structures to continue pushing lower. If price is coming back to that area, it will take you out. Okay, it is not more valid. This is a daily range. The price has to quickly deliver the market. So most times it will only give you entry once, but you can still be taking out some scalping trades or day trading. Okay, you can still be taking those. Okay, you have a fair value gap, trade into that, so you can still be taking scalping trades or day trading, and you do that while being mindful of your session. Right, so you can see right here Asian session taking out, trade backwards, so we have in Asian high taking out, Asian low taking out, we trace on London or possibly New York, and we now see drops, Asian, bam, London, it drops, and it traded into a fair value gap right here. So you should take note of all of this, and you can just be scalping the trades till it gets to previous month low, and you should take note of that. Okay, so I hope that this content helps, and I hope that it's very, very educative to you. So to then I need you to practice your chart and follow the rules on how to use the algorithm prediction and algorithm daily range, and also study. So till then, see you next time. So take care of yourself. For me, bye.